Hi guys, just waiting for a few more people to attend. We've got attendees that are clocking up at the moment, and then we'll start. Be with you in probably no more than a minute. Right, guys. Well, I hope everyone's had a lovely Christmas and New Year. So happy New Year to everyone. What I'm going to do first, we're going to launch a poll just to actually get people's views of what they feel that the property market's going to do. So let's launch this poll, and if you guys can fill that out, what you think it's going to do. All of this is anonymous, by the way, so we can't see who's filling in what. So if you that's quite interesting. Okay, so I'll share these results with you. Okay, so most of you actually feel that it's either going to remain static or fall. So we've got 44% think it's going to fall by 1 to 3%. There's 22% fall by 3% and remain static, but only a small amount of you is going to rise by over 3%. So right, well, we feel slightly different. There's a number of reasons for that. We do agree with you that it's not as straightforward as it was maybe going back 3 or 4 years. However, we feel that there's a lot more opportunity in the market now, especially to pick up some great bargains, because developers know that in certain areas they're going to be pushed. So let's start to see what the predictions we feel are going to be. So first of all, what I look to do is have a look at what's happened in the previous year. So we're going to take a look in what's happening in 2018, but I always start actually with what the experts said in the previous year. So I'm always quite keen to pick up a paper at the start of January, and whatever paper you read, it's their predictions for the property market or the stock market. And you know what? You go back, let's be honest, it's a guessing game. 50% of them are wrong, 50% of them are right, regardless of what they look for. So the house prices that we saw, this is in 2017. This is what was predicted. So Henry Pryor predicted there was going to be a 4% fall. Obviously, Martin Ellis, well, we can see him. He's hedging his bets there, anything between 1 to 4%. So obviously, he can't go too far wrong. And then a lot of the others were actually incorrect. The only one that was right was Simon from Ricks, who predicted a 3.6% rise. So actually, according to Halifax, it was 3.6% in 2017. So Savills actually produced one chart, and again, I looked at that chart for 2017, and again, I'll be honest with you, the best way to read that chart was literally turn it upside down. They would have been better to flip the chart upside down, and they would have had more chance of being right than the actual chart that they produced. So where do we think it's going to go? Now, look, it's one of these markets at the moment where there's a lot of variables and a lot of unpredictability in regards to Brexit, in regards to interest rates. But we feel that although we're not in 2010, where we've hit the bottom, we feel that we can safely see 4% growth. Well, actually over 4% growth. There's a lot of factors affecting the property market last year. A lot of people had purchased a lot of buy-to-lets the previous year to get around stamp duty. Then we've had Brexit. Although that we safely say that we're not going to see on average double-digit growth, we still think because of the number of factors out there that the market's going to grow just over 4%. This is one of these things in mortgage rates. Now, despite the rise in interest rates, mortgages are still ridiculously cheap. when I actually wrote this article, I actually looked at a few mortgages, and there are so many mortgages available for as little as 1.4%. Now, that is so cheap to borrow money at that particular rate. I've got here with me Paul Tillett. Paul, as you know, is a sales director here. He was an interest rate trader in the city for what, 20 years. So I'll let him speak to you a little bit about about interest rates and where he feels they're going to go.
Hi there, guys. Well, as we know, interest rates have been near zero for the best part of 10 years. We saw an increase. Papers made a big thing about it. Rates double in from 0.25% to 0.5%. Now, if you're of a certain age, my age being slightly north of 50, we'll remember rates at 14–15%. So when we talk about rates of 0.5%, 1/4%, 1%, even if we quadrupled the rates now, we doubled two over a period of 2 years, we'd hit 2%. Historically, those rates are low. I mean, I don't see, for me, the UK interest rate market going anywhere near a 4%, 5% mark for, if I'm honest, I think 5 to 10 years from now, I don't think we're going to see 5% rates, 4% rates for a very, very, very long time. I don't think rates will get that high. If you look at 10-year gilts, which are an indicator of where predictions for interest rates are, the yields are nowhere near the levels they were back when I remember rates at 10 and 15%. It's just a market where inflation, although it's picked up and it has begun to grow, it gets reacted to quite quickly. Any micro move in rates, even though it's a small amount, but doubling of rates to 0.5% or even pushing them up to 1%, which is where they're sort of predicting to be sort of towards the early part of next year. It's an interest rate environment that's very cheap. It allows for cheap money still, and it allows investors to borrow money at rates that you know we can just used to dream of, and that is impacting. And I just think that that's going to remain. We have seen lenders change the rates at which they're offering their mortgages, but they're only small increments. And again, money remains cheap. That's where I think we're going to maintain for at least another 5 years.
Yeah, I think that's a huge factor, because as soon as the rates start to tick up, that also impacts the next point that we come to, is where else is there to put your money? Because rates are unbelievably cheap currently, that also means savings rates are pretty much at an all-time low. Again, so what this effectively means is, where else is there to put their money? If it's not property, if it's not buy-to-let, what do? Well, savings rates are at an all-time low, so you can't really say that that's making. I mean, inflation was announced that it fell today from 3.1 to 3%. But if you're making 1% on your savings rates, you're still effectively losing 2% per year, because inflation's at 3%. Then you go to the stock market. Well, you're looking at the stock markets currently at a high. So again, do you put your money in the stock market when it's at a high? And again, the stock market is where investments can not only go down, but they can go to zero. I'm not saying they will, but they can go to zero. That's something that a property can't do. And bonds rates are at an all-time low. So what we feel here is that, due to the fact that other investments aren't as popular or aren't as lucrative as they once were, then they always come back to property. Again, there are other things out there. You can, overseas savings rates where you can go offshore for 10%, but you're looking at countries which are literally don't have the stability.
I mean, can I just interject there? I mean, just a quick referral, just 10-year gilt yield actually sits at 1.3%. So that just indicates where people think rates for UK government bonds sit in 10 years' time, which is an indicator where interest rates will be. I speak to a lot of fund managers, and last year and the year before, they found it very difficult. We've seen them diversify into other areas. They've moved into property. These chaps are trying to give you absolute returns, or they're finding it very difficult to perform in the normal market. They're looking for diversification. They're looking to shift into other asset classes, because the standard stocks, bonds, and the usual are very, very difficult for them to make money, and make money in a responsible way, in a nice steady way. And that's another thing why properties perhaps hit their radar a bit as well. We've seen that in a sector we've looked at before here, is the PBSA stuff, and a lot of American funds look at that. But the point I'm trying to make is, it's very difficult for absolute return funds, or funds in general across the market, to make a good return in the classic asset classes they normally play in. And that's led to a lot of redemption of money, and it led to a lot of cash leaving some of these funds. A large fund in mind was a company called Bluecrest that probably about 2 or 3 years ago now decided that it was so difficult to maneuver the huge funds they had under management. They decided to return the money to their clients and ended up being a family office running their own money. That just tells you how difficult it is elsewhere to make money in an interest rate environment that's very, very low.
And I think that due to that and due to the change in demographics as well, Paul, we've seen, I mean, we've been going up to Manchester for a number of years now, and the change in demographics is and places like Liverpool is quite substantial. 5, 6 years ago, we saw Manchester and Liverpool where it was pretty much of 8, 9 years ago, not much change. And suddenly we've been up, we go up there, the shops change, the cafes, the restaurants, the hotels, the demographic of people is changing, and so is the surrounding areas, right?
Yeah, well, wage increase, you've got the better economic jobs up there. You've got the classic stories we mentioned with the likes of Manchester, with the media industry moving up there. That's brought along other associated industries. You've got finance up there still. You have a lot of these consultancies, KPMG. So, they're all based up there as well. And these higher economic jobs attract, obviously, the sort of people that have worked in London in the past. If you work now and live in the Manchester area or Greater Manchester area, you're sat no more on a stone's throw from lovely places like the Lake District, just as a way of life, and the way that people now look at the way they live their lives has created a real focus on the likes of Manchester, Liverpool, Leeds, because you just get a better way of life up there, and it's just less, it's just more for your money, and it's just a place where people like to live. And that demand is set to grow, and that's one of the other reasons why places like Manchester, Leeds, Liverpool, etc., prices are still set to push higher. There is a lack of supply, there's a great demand, and the demand is coming from people that demand higher end properties. So coming from the likes of London, West London, when they're working around with the BBC, and these people are looking for properties where there are none at the moment, and that's why we're building in the likes of Manchester, Leeds, Liverpool. There's cranes everywhere. There's no end of properties being built, as you see, but there's nowhere near enough.
And I think that goes on to when we sell to residential clients, which we do as well. We tend to have residential clients, and the difficulty that they have is they want something now. They want something ready now. Everything that's being built is 12, 18 months away. So this offers you guys a chance to get on board something. And then when it comes to being completed, you complete on that and you sell it straight away. We've just had a client who purchased 18 months ago into a project. He bought a 2-bed for £145,000. That at the time was, a normal price for that, slightly below market value because it was off plan. But now there's a building next to it which is 250 for a 2-bed. So he now got the opportunity to go and sell his. He's put it on the market. We're in the current negotiations. It's been accepted at around about 215, 220. But he's happy because he's making 60, 70,000 on his property. The client is happy who's buying it because they're probably getting it still 20, 30,000 below market value. So there's opportunities to be had there, and I think that's the next step.
Yeah, I mean, it doesn't change. I mean, I've just come off the phone from a young girl. She looked to buy a place. She doesn't even need to live in it, but she wants to buy a place. She's 26, and she said to me, "I want it now. I can't wait." And I explained to her the situation with new houses. She said, "Look, I'm going to carry on looking," but that's the sort of client that comes to us and he's desperate for property. And the thing is, by the time it's built, it's sat there in front of you, they've all been sold. And there'll be plenty of clients, residential clients in particular, because there's a lack of supply. And that's the one thing she said. She said, "Well, I can't find anything." And I couldn't convince her to say, "Well, look, buy it now, you don't need it," and sit on it. She said, "No, I'll wait and see. I guarantee you I'll be speaking to her next week." And she'll be saying, "Okay, fine, I need to reserve something because you're right, there is nothing available." And that supply shortage is set to be there for another 5 years comfortably.
It's a bit of a myth. I mean, a lot of people go to these cities, so, there's cranes everywhere. Well, there must be an oversupply. It's not. That's an absolute myth. They could probably have 4 to 5 inquiries for every one particular property. Now, in regard, again, it kind of just says what, this slide just says what we just said. It is a demand and supply. We don't just say take our word for it. We'll provide independent research which shows what is needed and what's actually supplied. And what you've got to realize is 1 crane or 2 cranes might only mean 200 to 300 apartments. Well, that might take 3 to 4 years to develop. So again, it's not as if they're putting up 400, 500 in each space per year. Now, what does it mean for you? So from an investment perspective, our advice is to make the purchase. Well, again, I suppose a lot of you might say, well, you would say that, that's our job, and that's how we earn our money. But genuinely, you know, we've seen a lot of people procrastinate last year, say, oh, they think the market's going to dip, and now they're still saying the same thing this year. But what they've done is they've actually cost themselves, in some areas, 10, 15%. So, you know, at the end of the day, it's always the same. The chances of you ever getting in at the bottom of an investment and out of the top is slim to none. Very few people do that. However, what you want to say is, you know what, if you're looking to hold it over a certain period of time, and for property, we always say you've got to at least think about 3 years, 4 years, 5 years, even plus. If you're looking at a 1 year to turn around and get out and get into something else, best not speaking about property. Our thoughts of property is a long term, because we may have another 2008, maybe not as bad as that, but there may be another dip. So due to that, we have to just ensure that people are looking to hold, and if it does dip, then it will come back up.
Just a quick interruption there as well, is that a lot of you know, we concentrate, as you know, on properties in the northwest, typically out of London. A lot of these figures the UK have, I mean, the UK nationwide are expected to see over the next 5 years property prices rise to about 14.5% to 15% versus 28% for the previous 5 years. This, in everything we look at, in any article we look at, London looks like it's drifting, going lower. Everyone's predicting the same thing, a 3 to 5% drop in London. I would suspect in the next 2 years, because we see it, people trading 10% low on London off the present asking price. I think they're too high. And all these figures we have, that's the sort of figures that are drawing the southeast and London are drawing the national figures down. Every research we've seen in the northwest predicts still for strong growth. You can't get away from it. There's a demand. You can't get away from it. There's more businesses turning up there. And you can't get away that geographically the northwest is central in the UK, and it's the demand sets continue, and we expect prices to continue to rise. We're not saying double-digit rises, but we're expecting anywhere between, I personally think, in the likes of Manchester, between sort of 4 to 10% or 5 to 10% a year. And I think Liverpool, the same sort of number. Yeah, that's the sort of figures we're looking for, if I'm honest, and that's, I think, going to continue.
I think what we'll do as well is, I think what's going to be very useful, and I've got my PH3 up my diary all of next week, and I'm not asked Paul about this, but we'll just put him on the spot. What we'll do is I'll send you a link to my calendar, and then we will just give free 15-minute consultations to everyone, video calls, FaceTime, Google Hangouts, Skype, however you guys want to do it. So we can sit down, and then, as the difficulty is that on these things is we've got over sort of 150 attendees, 200 attendees, and what basically happens is then there's so many questions that we just struggle to get down them all. So some questions might be bespoke to you. So we'll send you over a calendar link after this, probably about an hour after this. We'll also send you a recording, and you click what slot you want, and we can have a catch up. You can sit down with us, take your time, and we can go through anything you've got to go through as well. So that then brings us on to what's the best area to invest in. Now, while this loads up, specifically, we feel that you're probably looking at, as I say, 4% as a whole. But in regards to the best areas, now that really depends on you. So, for example, if you're looking at maybe a 7-year plan or 7-8 year plan, then you've got the luxury of going into areas, for example, like Liverpool Waters. So Liverpool Waters is an area which is phenomenally reminiscent of Media City or Canary Wharf. It's an area which, in my opinion, is hugely up and coming. Apologies for the slide there, guys. Liverpool Waters is a £5.5 billion regeneration project. But again, if you're looking for 1 to 2 years, horrendous. You don't want to be investing there because it's not going to have the time. You're not going to be able to give it the time. So as I say, 1 to 2 years, you're looking at a property. You're not going to be able to reap the benefits, in my opinion. So I would advise you look elsewhere.
Why? And equally, if you're buying property, why? If you're there for the uplift, I mean, the thing with anything, when you buy a property in an area, if you're buying a property, you know it's been earmarked for regeneration. You're buying quite early, so you're an early investors. You're in an area. You're capturing the bulk of the uplift. I know Chris said earlier it's very difficult to get in at the start and an exit at the end. If you know an area has been earmarked for redevelopment, they've got the money allocated, it's been put on plan, There's plans in foot. There's plans being passed by local government that's pushing things and putting industry through there and tying up the whole area. Then you know that if you may be the first or second or third building on those sites, that you get in there. You're an early investor. It's built within 2 years of you buying, and then you sit with that because you know for the rest of the time there'll be probably another 5 or 6 years worth of development going around. In Canary Wharf, there's the main tower. Then they started building other stuff. That area didn't really get going for about 10 years. And when it got going, it absolutely skyrocketed. And that's what we're expecting in the likes of Liverpool and Manchester in the same sort of vein. It's going to be a sort of area where you're in it. It will look good. The price will increase, but then you'll hit a point. And that tipping point is when it goes and it skyrockets. And that, in my mind, is you buy now, you look to sit on that for probably 7 years, 5 to 10 years. You're earning money on it all the time. It's not costing you a penny. You've got an uplift. It's very cheap to fund. That's not likely to change. As I've said, 10-year gilts are still 1.5%. It's very low yields. And you're getting great returns in a market that's got nowhere to get great returns. And then what you do get beyond that is 7 years from now, when that is a brand shiny new area where the whole Liverpool is done. There's these huge developments. There's retail. There's commercial areas. The whole thing is brand spanking new and it looks beautiful. And there'll be people coming up and going, oh, I wish I'd have bought this 6 or 7 years ago. I'd have made a fortune. And that's where you guys are the early investors. You get in there early. It's not a thing that they're hoping is going to happen. It's been earmarked. It's been done. And it's just a case of you being patient to reap the rewards.
There's a saying in the industry as well. It's better to have the worst house in the best area than the best house in the worst area. So what we're looking at is we're looking at those regeneration areas that will become the best areas. And then what you can basically do is you can bet your bottom dollar that it doesn't matter what you've got. There will be some cheaper developments in the area and some higher end developments. But whatever you've got, if you're in the best area, that's where you want to be. So a lot of people, they get very emotional about what they buy. We have a lot of investors who look to buy something and they're like, oh, you know, I could do with it being a bit bigger, or I could be doing it with maybe a different style of kitchen. Do you know what? When it comes to investment, every tenant is unique. Some want a certain type of kitchen, some want others. The main thing is that we're getting in areas that we feel are going to be hugely worked on, hugely regenerated, big changes, and that's where the money's made, and that's what pushes you up in price. And again, there's a lot of people feel that they can't wait. There's a lot of people feel that they can't wait because of you know, it's off plan, and they feel that, you know, they will have money working for them straight away. But look, our advice is this is a myth. If you think that you're going to buy something now and it's going to make you money straight away and you're going to have far better income and growth than the property or plan, that's a myth. Yes, you will have income straight away, but you certainly won't be getting it 10-15% below market value, which is actually what you can get if it's off plan. And that also contributes to the fact that you know, that basically covers your income that you would have got. Also, you're not taking on someone else's problems. Most people, if you've got an apartment that's giving 6% plus, what else are you going to do with your money? If someone's selling it, there's normally a reason. You guys must know when you've moved into your own property, if it wasn't new, there were things to do. More than likely, there were things to do. Rooms to paint, maybe a boiler to change, things go wrong. So what we say is that we've experienced it time and time again. A lot of investors say, no, I want something now because it generates income now. It's a fallacy. It's a false economy. You buy something, you think you've got income now, but you've also got problems straight away, and you're out of that 10-year guarantee period as well. Now, in regards to individual areas, as we mentioned earlier, yes, we feel just over a 4% increase, but what about individual areas? Now, London, Paul, this is your forte. You know, this is he's smiling because I put him under pressure here, and so this is your forte. Paul lives in London, so personally, I think it's going to be static to maybe a slight dip. Personally, over to you, Bud.
Well, in the last year, I think it's dropped about 3.4%. I'm renting presently myself in London and waiting to buy 18 months from now. That was my viewpoint. I've maintained that, held it all along. I think we'll see, what we have seen is asking prices drifting lower. I think Rightmove just chucked out some stats at the start of the year. They had a 10% increase in hits on property, and they'd seen a 1% rise in prices. Their view is, though, that asking prices have been pushed a little bit higher and market movement is slower. They feel that the property market in London is going to be a slower one to move, to shift, and I think in turn asking prices are going to drift and drop lower. I think in turn transaction prices will sit lower. I think if there's a desperate buyer wanting to buy in a certain area, yes, they're going to pay up. They think, oh, great opportunity. But if you watch it and as the supply builds in London, I mean, with Brexit coming out, there is going to be people moving back to Europe. There are going to be people shifting and changing. But in the market we're talking about, not the very, very high end, that's a different market altogether. We're talking about market ends where investors get involved. I think you'll see the prices drift a little. Probably, I think this year, I would suggest near a 5% drift. I'm hoping it's going to be near a 10% in 2 years, but I'm probably likely to be between. Yeah, just so I can buy. I think it's likely to probably bottom out around 7% drop in the next 18 months. And then that's where it's going to sit. Demand will be there and it will hold tight. So that's London for me on where it stands.
I think also the price to earnings ratio, this is key. There was a report by Home Track and it said that actually for your average property in London, you need to be earning 14.5 times, or you need to get a mortgage 14.5 times your salary to make that purchase. Now, there are no mortgage companies out there that are offering that. Hence the reason why you still have a huge amount of renters. So then what happens? What do? Well, they look outside of London. You know, these people want to buy, they want to get on the ladder. So they either rent, which is again sky high rents, but they look outside. So what we now do is we look at commuter towns. Chelmsford is a great example of a commuter town that had a boom. We're probably now being voted the worst vital area in the UK, just because prices are so expensive because it was a great commuter town, or a great commuter city as it now is. But areas that are still, have a great opportunity and a lot of work and regeneration in the area. For example, Luton, we have 6 apartments that came back onto us. We got exclusive off-market apartments last Friday. We haven't even started marketing these yet because we've been so inundated with requests. But again, 6 opportunities there, which Luton's going to benefit greatly from being one of these places. It's 35 minutes outside of central London. We predict that you're looking at about just over the 5.5% mark in 2018, which is still great growth. It won't be as much as I feel that you're going to get in places like Manchester, Liverpool, Leeds, Sheffield, but you've still got that suburb, or I shouldn't say suburb, but you've still got that that commutable times, 35 minutes from central London. So that's why I think that you could get 5.5%. Again, rents in Luton, I feel, again, you should be aiming for a minimum of 4.5%.
Got the airport 5%. As well, which is key. That's another thing. Luton Airport, again, sorry, that's a classic line. But yeah, Luton is being improved. The Luton Airport, the link is the hub, or home was the home of EasyJet. It's a busy airport, and that's, again, great for whether it be foreign investors, people that work in London and want to get back home to Geneva. It's a great route to Geneva. The whole thing outside of City Airport, Luton's one of the better ones for that. Yeah.
And then it moves up to Manchester. As you know, we're keen on Manchester. We've been selling the apartments there for a number of years. Prices have pushed up. What we said 3-4 years ago, Manchester exceeded our expectations, but it's a great city. Again, we would still look for over 6% increase. You've got to be careful in Manchester. What some developers are becoming very au fait with, that because Manchester's so popular, they're just slapping on another 10-15% onto that off-plan price, and they're actually marketing them as if they're ready, and they're getting that price. So that's why you need an independent broker, not just to push us again, but just be careful when you go direct to developers, because you can get some good deals, but again, a lot of them have been overpriced. What we do is we handpick them. There's one particular development, which I won't say what it is, but as I say, there's one particular development which is hugely overpriced, which we haven't touched. We have a lot of inquiries about it. We won't deal it. It's a nice location, but they've just put on another sort of 15% what it is, and we just feel that developers are kind of taking the mickey there. They're kind of taking investors for a ride. So what we'll do is we'll really grind the market down. We'll search that market. We've got one that's launching, should be either today or tomorrow. And again, you can still pick up one beds for 135, 145, give or take. That's kind of still a fantastic price to be at. Whereas we have been selling one beds, there are one beds 180, 190. So there's some great opportunities to be had still in Manchester. Again, just over 6%, and at least 5.5% income here, in my opinion. And then Liverpool. I mean, Paul, you're a big fan of Liverpool. I mean, we mentioned Liverpool Waters, but I think one thing to say about Liverpool is Liverpool, since it's low, it's an area which has increased since it's very, very low, but it's still 6.4% behind its peak. So when the market, that means when the market actually bottomed out, when it actually hit its rock bottom, well, Liverpool's increased 18.7%. Now, Manchester's done a lot more than that. You know, most London's sort of 50, 60% or plus, but most are well above 18%. But it's still 6.4% below its peak. There are only 4 cities that are still below its peak. Off the top of my head, the next slide might come. I think it's Liverpool, Glasgow. There's another one in Scotland. I don't know if it's Edinburgh, Liverpool, Glasgow, and I can't remember the other. It might be on the next slide. But yeah, I say there are only 4 cities, and Liverpool is one of them that is still below its peak. So again, we predict a bit more than Manchester. You know, we should see sort of a 6.5% growth. But in the areas Paul spoke about earlier in regards to Liverpool Waters, those kind of areas, if you get in now, in 2 years' time, I think you could see 10% per year. Not on the average property, but in the right areas. And for me, that's the key. So all in all, guys, I think that you know, there's great potential to be had. It is a bit more like finding a needle in a haystack. Now, it's not like it was, as I say, you know, 5 years ago, which is extremely straightforward. But again, I think that a lot of people, a lot of investors that we speak to, there are a number of reasons why they haven't invested. So I'm going to launch a couple of polls now. Let's go to, sorry guys, let's go back to this. Let's go to this. Right, let's launch this, guys. So a lot of people haven't made the plunge or haven't taken the plunge yet. There's normally a variety of reasons why. So just launched that poll. So again, this is another anonymous poll. So why have people not made the decision to invest so far? Okay, some interesting answers here. Right, so let's close that poll. Okay, so we've got here price rises put me off for 11%. Yeah, I get that. Negative, yeah, it's a really good one. Negative news surrounding buy-to-lets, 56%. Again, yeah, do you know what? It's always the way. Whenever the market's doing well and it's coming up the top, you just get more negative news, and you can't avoid it. It doesn't matter what paper it's in. I mean, the Telegraph. I read the Telegraph. It's amazing that there was an article last week saying that last Thursday, I think it was, how fantastic buy-to-lets are. You know, these are the areas to invest in, buy-to-lets. And then on the Friday, there was another article which said don't buy buy-to-lets. So it's one of those things which is unbelievably contradictory. But I get it. You know, you read stuff, it makes you a bit nervous about where to put your money. I think what you've got to look at is, am I making money in a savings account at the moment, which is probably where most people's money is? The answer is no, you're actually losing. So again, it goes back to, do you know what? Property prices will still rise. Let's say they do ever fall. We don't think there's going to be a fall this year, but let's say they are. Well, then there's more likely rise the next year. And if there's another fall next year, then they'll rise again the year after. You're not going to get in at the bottom. Again, not enough knowledge where to invest. Again, hopefully that's where we should potentially do better. Again, it's easy for us. We deal day in, day out with this. So it's very easy for us to say, yeah, invest in Manchester or Liverpool or Luton or wherever. But for you guys, again, don't be afraid of saying to your broker or saying to me, do you know what, I just need more information. I need more independent information. Want higher yields? Yeah, we have a lot of that. We have people wanting over 10%. Unfortunately, most of the time, they're just not there now. It's not like it was a few years ago. And yeah, the last one, finding it hard to make a decision. I get that. It's a lot of money. We're not talking about a £5,000 investment. We're talking about, you know, a 100 or 200 or 500,000 pound investment. So yeah, I fully understand that. In regards to making a purchase, if we could prove, again, or not prove, if we could demonstrate that why we feel that the market's going up, when would you guys look to make a purchase? Because some people say within 12 months, some people within 6 months. It kind of varies. Some people are not actively looking. So I'll let this one run for a little bit. Okay, people are still going. Okay, so let's close that and share that. So guys, there you go. So 13% not actively looking. I'm guessing that's something, if something absolutely fabulous comes up, then that might be worth looking at, but not actively looking. Something in the next few weeks, but mostly within the next 3 months. What I would say is, whether you deal with us, whether you deal with another company or direct the developer, just try and get, what people do is they decide that they're going to do something within 3 months, and then they put it off to the last minute. What I would say is use that next month, 2, 3, whatever you're looking for, or however long you're looking within the next year. Look at that time period as your research time. That's your research time to do as much research as you can on that particular property or on that particular area, and utilize that wisely. So when you're ready and you're ready to pull the trigger, you're good to go. Again, those of you that are ready within the next year, that might be due to finances. Again, a lot of these developments now, they don't require as much as they once did. There are certain developments that only require 10, 15% down. And there's opportunities to buy those, and then the rest of the money can be got by savings or mortgage towards the end of the year or beginning of next, something like that. So there are opportunities. What we're going to do now, guys, we're going to open up the floor to questions. So you guys should have a button where you can request some questions. So let me hide those results. You guys, see if I can get you back to my screen. Okay, right. So any questions, guys? We've got some here. Oh, Happy New Year. Thank you. Got a question here. Leeds appears to be expensive compared to the other two. Will you still be pushing Leeds given the current price? Yeah, do you know what? Leeds is a bit of an anomaly. I've got a family in Leeds, so I'll be going up there quite a while. Leeds for me is a small city. Therefore, anything city centre, it kind of, it's they call it the second financial city behind London in the UK. It's full of lawyers, so you get a lot of expensive builds, great architecture, a lot of grade 2 listed builds. I personally think Leeds is something which is can buck the trend. It's still actually not as high as it once was. Leeds was really dramatically high. They're building a place called Kirkstall. They're building, or they built a train that goes straight into Leeds. Place called Halsforth as well. You're still talking about Halsforth. Now, bear in mind, this is just outside of Leeds. It's a suburb of Leeds. You're still talking about 400,000 or 500,000 for a 4-bed property. Now, that's a lot considering it's Leeds and it's Halsforth. So yeah, I think Leeds is a bit of an anomaly. Yes, it might look higher in price than what you get in places like Manchester, but it's a smaller city, denser, less places to build, and you have a lot of people want to live in that city centre. And what you can do, guys, this is key, is Airbnb lets. A lot of people don't realise this, but Airbnb lets is a way to really get your portfolio performing for you. Again, it's something we can help with. It's something where you can probably make upwards of 12, 13% because you're doing it a different kind. It might take a little bit more managing. You might need to just do a little bit more work on it, but it's something that we can help with. Being an overseas buy-to-let investor, I've got a concern about the value of the pound. So what would be the outlook of the pound when Brexit is in operation? Over to you, Paul.
Well, unfortunately, no one knows. Experts don't know. Foreign exchange traders, it's very binary. I think the given view at the moment is uncertainty scares markets. Uncertainty scares currencies and keeps it depressed. Personally, for myself, I think value of sterling, I think we are going to get a deal for Brexit. It's down to personal views. I mean, if you don't think we're going to get a deal and we're going to go to WTO rules, then you know what, sell sterling, and that's the trade. And if I'm honest, you then, as a foreign investor, you either do some forward arrangements, some FX, or you turn up next year when it doesn't work properly and you buy more property at a discount of probably another 20%. My view is that everyone's going to go for a deal. It doesn't help Europe, doesn't help us. We do get a deal. Once uncertainty goes, sterling will gradually go back to where it was beforehand. I don't see the valuation of sterling drifting too much away from where we are now. The only thing that kills it is uncertainty. The moment there's uncertainty out there, no one knows. That's what's the problem. So there'll be price fluctuations in the currency. It will remain weak until we have some definitive answers from the politicians. But once we get there, I mean, as an investor, I would leave your money in sterling. If it needs to be left in sterling, I guess your debt's going to be in sterling. If you've invested in the UK and you have debt in the UK, your debt's linked to sterling. If it's linked to a foreign currency, then you have to have a different consideration and you have to take a view on your currency. But we have ability. We've linked up with a foreign exchange provider that they can do what we call forwards. So you can then fix your price of sterling, whether it be for today or 3 months or a year's time. That is something they can do for you. You can find it on our website. It's Cornhill FX. And if you want to discuss with them anything, you can. So that's my advice there.
What's this one? Would more people leave UK or come to UK after Brexit, which may decrease or increase the demand for properties UK respectively?
There is plenty of demand for property, regardless of immigration. Immigration will not change. People come to this country globally will not change. The immigration numbers will be the same. The demand for sort of workers coming from Europe in and out, again, freedom of movement with workers and the need for European work. I don't see that changing too much. There've been a lot of agreements in place with politicians on present people that are living here and people coming forward. I think Europe's not going to be a huge change for us. Demand for property is high enough without that anyway. I think if we lost migrants or work migrants coming to this country, or people looking to move to this country to work, and Brexit taking place, there's a massive undersupply that is going to be eaten up with the UK population itself anyway.
What do you think the Northern Ireland market will look like pre-post Brexit? Do you know what? We're probably not the best people to ask. I don't want to give an opinion that's probably, it's not an area that we've researched. I'll be honest. So we're probably not experts at that. So my advice would be that if you're looking at the Northern Ireland market, it's best to just speak to local agents and what do people have a view about there. I say it's not our forte. So I apologise that we probably can't answer that better. Paul, do you have any?
No, I know that Northern Ireland's a bit different. There's some different agreements because it shares a border with Ireland, so there's be some issues there. But again, they're trying to make it so that it doesn't impact at all. So the view is pre-post Brexit, they want that pretty much to stay the same. The political situation there, the sensitive Good Friday Agreement, Europeans and politicians don't want to mess that up. They want to keep the status quo there. They don't want that becoming an issue. I think the situation between the north and the south of Ireland will remain the status quo. I think in dear. I think the reality is that they don't want to change things too much. Therefore, they'll try and make it as seamless and as easy as it can be. So I don't think it impacts too heavily.
Got one here. Up and coming developments in Manchester city centre, ideally city centre, as a lot of developments are advertised as city centre, but are not in very desirable areas. Yeah, well, this is twofold. If you're looking to live in the city centre right now, Tom, I don't suppose you could maybe just ping a question over to say whether this is for you to live in. If it is, I get it. I get that you may not want to live in an area which have a lot of building work going on, and especially if you're paying 250 grand for it. Renters will live in those kind of areas and they won't mind because they can see things that are up and coming. Investment wise, you may see them as not very desirable areas, but they will be desirable. So that goes back to what we said earlier. That's the areas you want to buy in for investment. But for you to actually live in, I 100% get
I mean,
it.
city centre is city centre. I mean, if they're advertising city centre and it's out south of Old Trafford, that's not city centre. I mean, if it's in a city centre, it is. If it's not the city centre and they're trying to tell you it is, then avoid it. And I'll tell you another way you're going to tell if it's not the city centre, if they're offering you 10% returns in Manchester. Yeah. I mean, the reality of Manchester is it's between 5 and 7%. It's probably as good as you're going to get. Any higher than that, the likelihood is it's not a great area and it's certainly not a city centre.
Yeah, Tom, you just come back to us. I've just seen that, matey, at the end saying buy to let. Yeah, so do you know what? I would go down. One of my favourite developments. Always go back to is downtown. It's between as you're walking down the river, you're going past the river. Well, yeah, you're going past sort of Cornbrook tram stop. All of that area, and the reason it's easy for us to say is because I've got a platform and I can see the next 5 years worth of development, and I can see what's going to happen there. So for me, although would be classified as outside the city centre, you're outside the ring road, you're walking down towards Media City. For me, that's still an absolute phenomenal area where you can pick up.
Anything that's a 10-minute stroll. Remember, Manchester is a smaller city, so you look at something like that. It's on the Airwall. It's a 10-minute stroll to Deansgate. It's probably a 20-minute walk to Media City from there. It's just well located. I mean, it is a small city, Manchester. Things can be considered city centre if they are within 10 minutes of city centre by walking. So that's how I would class it. But when I said city centre, I mean, some people are advertising property, out in the northeast of Manchester, a couple of miles out, a mile and a half out. That isn't the city centre, but yeah.
Good question here from Julie. You look particularly at property investment for a specific category of people, professionals. Would you suggest diversing to buy-to-let property for families in the northwest? Do you know what, Julie? It's a really good question. We get asked it a lot, and for me, it's a really easy answer, and the answer is no. The reason being is because although that it's obviously a required a property. You know, people, there's still families that need to rent. The reason why I personally wouldn't advise that is because you've got to look at your wear and tear of your property. If you rent to a family, you are typically going to get probably a house with a garden. That's probably what a family or young family would want. Therefore, what you're going to get is you're going to get a property that needs a little bit more maintenance to it, that you're going to have to arrange. But also, you're typically going to have people that are there more of the time. So more wear and tear on your property. Now, I've got 4 children, so I know what they do. I know that I get my lounge decorated, and then I know that they put pen all over the walls, literally a week later. And unfortunately, that's my own property, and I know what they're like in terms of how they take care of it, let alone in regards to someone who's renting, who probably doesn't take care of it as much as you would. And I know that, you know, you will have a younger family, you know, a child might be sick, might be drawing up the walls, and you just have a lot more wear and tear on your property, therefore a lot more maintenance. So you may think that you're getting higher income, but actually your net income is actually a lot lower over the longer term. Next question. Your view and structure of future purchases, limited company or individual. Okay, we legally have to say we're not legally you know, we're not legally qualified to give this advice. Yeah. However, for me, it's all about, you know, you've got to weigh up the pros and cons in regards to how many you're going to get. If you're going to get one, from my opinion, forget it. I mean, there's talk, but 3 or 4 is probably where you need to be over the next couple of years purchasing. I mean, what do you think, Paul?
Simple. It's just it's proven. It's 4 and above. If you want to set it up as a limited company, 4 and above is the way to do it. Anything less, don't worry about it. It's keep it as individuals. That's a simple rule. That's what they came out with. All the studies, all the reviews they looked at.
Next question. Speaking about Airbnb opportunities, are there developments in either Leeds or Manchester or Liverpool that cut the mark for this option? I'm getting wary of the news surrounding the resellability of student pods. Okay, right. Well, student pods, the ones that you don't want to touch with student pods are the ones where they are just literally a room, and off of that room they're called cluster apartments. So off that room you have the kitchen, and you have a shared kitchen, and you have a shared bathroom. That's not what you want. However, the resellability of student pods just depends on what income you're getting. If you're getting a solid 8-9%, you've got no problem in selling them. I mean, what you've got to look at is people bought them in the first place. So therefore, if you bought a student pod because it was paying 8%, there will be someone else that will buy a student pod. The issue that student pods have had, and the bad press they've had, is where they've had these, a bit like Paul said earlier, 10% guaranteed for 5 years, or 12% guaranteed for 5 years in areas that can't sustain that. There was one recently in Middlesbrough, it had something like 10% or 12% guaranteed for 3 years. But again, it's just unsustainable. So what basically happened is it then come down, it was in 6%, and then it makes it unsellable. Or it makes it more difficult to sell. You can still sell it, but you'll probably have to take a little bit of a hit on it. So what you've got to look at is you've got to make sure that if you do buy student property, it's its own room with its own kitchen, its own bathroom. It has a great location. Students are going to want to be there, and the service charge, you're not going to suddenly be ripped off with the service charge in years sort of 5, 6, 7 plus. So as long as you've got that, you're going to have no problem with selling it. However, going back to your question, the first one, which was about developments in Leeds, Manchester or Liverpool, yes, I've just bought one in Leeds. For that very reason, for that particular Airbnb reason. And the reason I can say it with confidence is because I'm up there all the time. I know the city inside out, and I know how difficult it is to find decent hotels for a decent price. So I end up going on Airbnb, and I know what they cost, I know what you can get. So again, same with Manchester. So there are plenty of opportunities for that particular development, for that particular reason, or that way of marketing it. Again, we'll send my Calendly link after, and no problem if you fancy catching up about that. Is it difficult to sell student accommodation? No, it gives high yield.
I mean, it's just the same reason you guys bought it. It's typically a cash market. My view of student property and student market is that sector is going to become an asset class for funds. It's going to be, a lot of people have done buyback options on these properties. A lot of developers have sold them with buyback options. They've done that because there's a couple of large US funds that come to the UK. It's very big in the US at the moment, purpose-built student accommodation. And they look to buy them as an asset class. They give great returns. These things have been running, so developers have been offering you guys kind of 3-5 years and then some buyback options on some of the properties you've had. The reality of that is that they are lining it up to sell to these funds or to banks as an investment. They'll have to provide a 3-year track record or 5-year track record on the income, and then the income itself will then get translated as an earnings for the company. The company then looks at it and says, right, they've performed like this over the last 5 years. we'll pay you X amount, and typically we've seen it from 10 to 25% uplift on the value. I just see the student market as a market that's going to be picked up on. I think the council of mortgage lenders are going to change their ways with student property. It's a very cash-rich environment. I think they've missed an opportunity here. I think they've missed a good point. I think once the mortgage people look at this, look at these properties, get their head around the fact that you can sell properties at less than 30 square meters, and there's a great demand for it, I think they will drift into that market, and slowly but surely, these properties will start to become mortgageable, and you'll start to see an uplift. And as soon as that happens, you will see increasing prices. But whatever happens with these properties, the reality is you earn anything between 7 and 10% yields, and that is great in anyone's book.
And yeah, it just goes back. You just got to make sure of the area. I mean, for me, you know, Leicester, again, we very rarely get something in Leicester because of its the density of the city. It's so hard to find a place. But we've recently had a Leicester one, and for me, that's the one at the moment. It's 8% net, fixed for 5 years, legal fees paid. It's just a great opportunity. We sold one in Leicester 4 or 5 years ago, Primus Edge, and it's fully booked every single year. A few people have sold. And they sold it very easily because it is paying those returns. The difficulty when selling, guys, is just when the returns aren't there. That's what you've got to be careful of. But when the returns are there, no problem at all. So
always stick with great university towns and stick with locations. They are key. If you're buying a student accommodation that's 20-minute drive or 15-minute drive, you need to be walking into the university or near the town centre. That is simple. That is the main rule.
I've got another question here. Apart from downtown Manchester, any developments lined up in the next few months in Manchester? Yeah, we've got one that we hope to launch today, and we've been told that it's they're going to sign off on the contracts today. By them signing off the contracts, all the land's being purchased. It's signing off contracts with us, so we can be exclusive in regards to marketing that. So yeah, no problem. Anyone want to drop me a line? It's Christopher.Whetstone, Whetstone. That's Christopher.Whetstone, Whetstone, at flambardwilliams.co.uk. I'll also, guys, I'll give out my personal mobile number. I may regret this after this, but I'll give out my personal mobile number. So it's 07375 031 338. That's 07375 031 338. And of course, what we're going to do as well, we're going to send this recording out to you guys. We'll send it out, but importantly as well, we'll send out a Calendly link so you can speak to me direct. We can have a real good chat, and Paul and I will do it next week. We're free all next week. Well, it'll be starting from Saturday, but all next week, guys. Well, look, guys, thanks for attending. I hope it was useful, and I say anything you need, you know where to reach us, and look forward to seeing you all soon. Take care.
Cheers.